Since everybody so enjoyed my last day trading video, today I have something really special, and I've prepared a day trading strategy. It's a complete strategy, and I have included a lot of tips on how to do a proper analysis of the multi-time frames, tips on finding the perfect entry with the perfect stop loss, where do you get in for a pullback, what is the best target, how do you manage your trade. And this is a very special video, so make sure to stick around until the end. There's a lot of practical tips coming that you can apply to any market, and let's get into it. We are, as always, starting on the higher time frame, and on the higher time frame we want to generally try to find a market where we can get a bias. So the higher time frame tells us, should we go long, should we go short, or don't we do anything at all? And then we drop to a lower time frame to find the perfect entry and time our trade. So this is one of the most profitable 3-candle reversal patterns. This is a candle pattern that if you study it, you can probably make a trading career just out of this pattern using in the right context. So what do we have? We have a few things that are coming together. We have a long uptrend. We have wave 1, consolidation wave 2, impulsive wave 3, consolidation wave 4, impulsive wave 5. So this has completed the regular Elliott wave count, and then at the top you can see the 3-candle reversal pattern. Strong bullish candle, the market is accelerating. Then we have a deceleration candle, can be a doji, a pin bar, and then we have a strong bearish candle. So the market shot up, consolidated, there was no follow through, and then we have the largest bearish candle that we are seeing through all of this uptrend. So very important signal. Not enough, but very important first starting point. Then we add the 14-period RSI. Here we have a divergence. The market and the price action shows us a higher high, but the indicator, the RSI, shows us a lower high. This means because the RSI is a momentum indicator and it analyzes how strong is the trend, it shows us that the impulsive wave here and here are getting smaller and weaker. And we can see that by just looking at the price action. This trend wave here, the top, is much shorter and not as steep as the wave before that and the wave before that. So we have a few things coming together. We have completed the Elliott wave theory count, we have the 3-candle reversal pattern, and we have our divergence. So this is the great confluence that we need on the higher time frame. Once we have confirmed that on the higher time frame, we know that this market may seem interesting for a potential short trade here on, and then we drop to a lower time frame. A quick tip here, because I've been mentoring traders for many years, and the problem that I often see is that the traders are on the lower time frames and then they see something interesting, maybe a pattern, a support level, a breakout, and then they forget to check the higher time frame, and then the time frames don't really align and match, and that's where you run into problems. So every analysis starts on the higher time frame, and only if you find something interesting there, then you're dropping to the lower time frame, not the other way around, or maybe not even looking at the higher time frame. So on the lower time frame we are on the 1 hour here, whereas previously this is the 4 hour. You can see we have a trend line. This is the wave 5. We can see if we would put another RSI here, we would get another additional lower time frame divergence. We have here a fake out pattern. This means that the market shot up, made a higher high, and then here the market, although it made a higher high within 1 candle, 2 candles later the market was below the low. We have a very nice trend line, and we have a support level that we can use here going forward. So we have a swing point, and the market is back at the swing point. Trend lines are a little bit more subjective than horizontal support and resistance, just because the nature of the trend line, you can draw it obviously in so many different ways, and adding a support level to a trend line is often really helpful. So a trading plan now could be that we wait for the breakout, we wait for the break and retest, and that is where we then look for trading opportunities once the market confirms that it's rolling over. I made the last video actually on my YouTube channel is a day trading dirty retest strategy, and a lot of people have problems with breakouts or retests. Although breakouts and retests are very common, a lot of traders run into problems. So if you have problems with that, make sure to check the dirty retest video. So now we see that the market did try to break out, but intra-candle only. There was never a close below that, and that's another very common mistake. Many traders use a pending strategy or a pending order strategy for breakouts, and that's where you run into fakeouts, because fakeouts are really common at those setups. So making sure that you wait for a complete And a fully closed candle beyond the breakout level is going to save you a lot of money on the long term. And then you can avoid running into those problems, because now obviously you don't want to be in a short position because the market has just rejected the level and is trading back into the highs. Now you can see the market did try to make a run here after the fake out, but the market never came close to the previous high, which is a good signal. And now you can see we have a fully closed candle beyond the breakout level. That is a good starting point. It's not enough to get into a trade, although some breakout traders which are more aggressive may now get into a trade. We are waiting for a retest, and now we are looking at a dirty retest approach. You can see this was the breakout. Then the market traded below this level for a few candles, shot up here with this huge engulfing candle. And obviously now you don't want to go short either, because now the market is showing a lot of bullish momentum against the short idea. However, if the market turns around and if we get a bearish candle, then we are looking at a potentially dirty retest, because this is the dirty retest area. This is the breakout level. And just think about it. What happens now? A lot of traders who get into the breakout here, maybe they are still short here from the fake out with the pending order. The market moves a little bit in their favor. And as soon as the market moves in their favor, what are they going to do? Previously, they may have had their stop loss somewhere here, but they moved the stop loss to break even, which is something that you will read in a lot of trading books or in trading videos. However, this is a losing strategy. And very often the market comes back to fish for those stops. This is not your broker hunting your stop loss. This is just general market theory and how professionals and other traders move around the price action. And you can see the next candle, we have a huge sudden bearish momentum candle. So all the stops, or not all, but a majority of the stops have been now fished for, they have been triggered, and now you're looking at a retest. In general trading, there's always a fine line between being too early and being too late. And one of the best tips that I can give you is just wait one more candle. I've been mentoring traders for many years. I've been trading myself for over 14 years, and this little rule, waiting one more candle, is often going to save you from a lot of troubles. So where's the entry now? So optionally, many traders are probably already now. You could also wait for the market to make a lower low. So you wait for this cluster of lows to break before you get in. That's a little bit more personal, depending on the level of aggressiveness that you want to have. Obviously, there's a trade-off. The earlier you get in, the less confirmation you have. If the market breaks below that, it looks more bearish than if you get in now, because we haven't cleared the lows. There's a little chance that the market will bounce here. So the win rate might not be as high, but you get a better reward to risk ratio, because the later you get in, the smaller your reward to risk ratio will be, because technically your stop loss has to be at the same area or roughly. So the stop loss is going to be a little bit bigger if you wait, and then the reward to risk ratio shrinks a little bit. So there's always this trade-off between too early, higher win rate, lower win rate, and reward to risk ratio. But technically there are options that you have. Breakout or pullback entry here. You have your dirty retest now. You could get in here, or you wait for the confirmed full continuation here into the new trend low. For targets, what we do is that we look at the chart context. We apply a fib. Here's the starting point of the Fibonacci. Here's the end point of wave 1. So wave A, B, then here's the point C, a very nice confluence on the 61.8. In general, if you apply a fib and you see that the retracement is very nicely respecting the C point and the fib level, that gives a little bit more weight to the fib. Instead of if, for example, the point C would be just somewhere between 50, 61, between 50 and 38, hanging in the middle of nowhere without really respecting a fib level, that's not as great. And then we are looking for the Fibonacci extensions. For example, here 138, 161, those are the commonly used Fibonacci levels as targets. Here's also a very important level that has been the starting point of the final wave that we have looked at on the higher time frame. So we have a lot of things here. And where do you put your target? Technically, generally, it's always better to not try to trade through those big levels. So in this case, you would like to have your target somewhere here above the green line, not right at the green line, because there's a chance that the market will bounce before that. And for a stop, you could place it here somewhere above the breakout and not the breakout, the pullback level, and where the dirty retest zone is. That would be one option only. So now you can see the market has reached the first green area. And if you have your first target there, okay, good for you, you might be out. And what do you do now? You can see the market is doing a retest here of the 100 level, and that is very, very common. You can see we have wave 1. Wave 2 is now here the obvious retest. We have a dirty retest approach again. And if you see that the 100 level is holding, there might sometimes be re-entry opportunities waiting for you. So for example, what you could be doing is just approach it the same as what we did here with the dirty retest. Get in. You could even go to an even lower time frame and look for a pattern there. And then for the targets, you could go beyond that, for example, the 200. So technically, it doesn't really make sense to put your target just underneath this green level, because there's a high chance that the market will bounce here and then you're looking at a potential losing trade. So you are taking this additional risk that is coming from the potential bounce here. And if you take a risk in trading, you need to be rewarded. And the reward comes in form of a higher reward to risk ratio. So if you take the risk of trading through this, it must be worth the reward. So your target should not be here just underneath the level, but it should be much, much further away, 200 or maybe even lower, so that if the level breaks, then you get rewarded for taking the risk. And if you take this trade or a similar trade maybe 10, 20, 30 times, there's a chance, maybe 50-50, that the market will bounce. So in 50% of the cases, you will have a losing trade, or maybe you manage it to get out as a break-even trade. But in the other 50% of the trades, you need to make sure that your winners can take care of your losers. And that happens by choosing a reward-to-risk ratio that is large enough. And you can see the market made it to the 200. After giving you here the dirty retest, we had here another challenge of the 100 level. This adds even more context to the trade, because we can see the market try to make another retest. Didn't make a full higher high here, but probably a lot of people who went short moved their stop loss somewhere much closer, and then were taking out. A lot of liquidity was freed up, and you can see the market collapsed to 200. Now that's how it looks afterwards. You can see the market put in a double bottom. Doesn't look super convincing anymore. So at this point, you are probably better off being out of the trade and waiting for the next opportunity.